Morning. I'm going to jump on the charts now, share my screen, and do a bit of a live analysis to go alongside those who have asked for it with their workbooks that they got. So let me share my screen. There. Right, so let's start with gold. I'm going to start on the weekly time frame, do a top-down analysis, and mark up my supply and demand zones. So get my fib tool. This is a lovely demand zone here. Just refine that a bit. So you've got two basing candles here, which is the base of the supply zone. And I'm going to get my drawing tool and just mark out my preferred entry, which is that green line. Right, so then I'm going to go to the daily time frame. Just ignore that for a minute because I'm going to go over that. So this is our daily, and I'm going to refine this demand zone further. So you've got lots of demand zones here, for example, right? So now that we've zoomed in, you've got another demand zone there. Refine this demand zone. Actually, yeah, there. So you've got demand zone here with a preferred entry there where that green line is. You've got your base candles and a strong leg out, which is pushing up to your buy. You've got all of this liquidity here, which is price will, especially gold, is always going up in a continuation. I do believe it's just a pullback, but it's pulling back into these zones to take this liquidity out. Hence why I wouldn't get into any buys now, because I do believe it's going to come back down here. And you've got another zone here. So you've got your base candles, the top of the wick to the bottom of the wick. Put your fib tool on there. Get your preferred entry, which is the top of the actual candle. So not the wick, the base of the candle. And then your green lines are your entries, your preferred entries, right? So if you go back onto the weekly, it doesn't show up the fib tools there. So this is my weekly demand zone. So if I was going to put my long position tool here, stop loss would be under on that red line there. And that's a 33% stop loss. My entry is on that green line here. And then, I mean, the next higher high on the weekly time zone is right up here, okay? So that's not an intraday trade, that is a swing trade. So that trade there is an amazing risk to reward. It's like a 1 to 37, which is huge. So it's a huge risk to reward, but it's a swing trade. So that move there, that trade could take weeks, months, it could take ages. If you weren't wanting to wait that long, you would then go down onto the daily time frame and you would look at these entries here, right? So it's a refined zone. And what you would do, say you wanted to enter on your first demand, you wanted to give that a shot and see if that holds, you would put your long positioning here. Your stop loss goes on that red line, which is your 33% stop loss. Oops, eyes. mark up my preferred entry. So that's here. So it's a better risk to reward. So at the moment, if I wanted to get into that trade, yeah, and I wanted to target the previous lower high, that's a 1 to 3. If I wanted to refine that zone slightly and put it to the green line, which is my preferred entry, then you're looking at, I need to just, a 1 to 4, nearly 1 to 5 risk to reward. Right, so that would be a demand. I wouldn't enter any longs at the moment. I think that gold has not finished this pullback. So I wouldn't be entering any longs on a daily time frame. I would be waiting to see what gold does, let it show you its hand first. I would be waiting to see what it does at this demand zone here, which is a really nice demand zone on the weekly time frame. Okay, I'd be placing my order there. Stop loss where the red line is, 3.5376 or 3. And then I would be targeting the previous higher high, which is the top of this wick here, which would give you a 1 to 11. So not as good as the 1 to 37, but that's still a beautiful trade. And you would obviously be making 11, nearly 12%, risking 1% of your capital. So I would be interested in that demand, that long position there. Because I don't think I don't think gold's finished pulling back at all. I think there's a lot of liquidity that needs to be taken still. Right. Ideally, you don't want to be trading the pullbacks. You want to be trading the continuation of the move. But if you're impatient and you want to do intraday trading, or you're not wanting to swing trade and you want to practice, if you're on a demo account, then you can look for your supply zones on the 4-hour time frame. So let's have a look, see if we can get a supply zone on the daily here. So see this gap, price is always attracted to gaps. They're like magnets. So if the market opens on a Sunday with a gap, like there's one here, and it has been gapping up or down lately a lot with all the pairs and especially stocks and gold, there's a gap here. So this gap up and then it flew down, but it's always got to come back here. So just say, for example, I marked this up as my supply zone, yeah? Price had moved down, it came up, it tapped it in, and it went back down. So if I had that trade on there, I would have entered here, stop loss at the red line. And even if you wanted to target that lower low there, you would have been risking 1% and gaining 2%. So it was a nice trade, really, if you wanted to intraday trade and not swing. That would have been a nice little trade. So what my point is price will always come back to these gaps. So don't think you've missed the move. You haven't. It's going to go down and it will come in and tap into your zone to then get into the trade. So let's see on the 4-hour. You can see on the 4-hour, your lower high, your lower low, your lower high, your lower low. So what we want to do is look for a zone that's quite fresh. So we need a nice leg in, a base, and a leg out. So I would be looking at, let me see. Right, so 2 zones here I would be looking at. this would be a D. If I was going to score it from A to D, D being the worst, A being the best, like you want an A+ setup ideally all the time, but I would say this is a D setup, right? Because chances are price is going to come further to take this liquidity, but you can take your chances, risk low. And I just want to add, this is just for educational purposes. It's not financial advice. And you always want to protect your capital and don't over risk. Right. So that would be an option. So that's a 1 to 2.5 risk to reward, R&R. My next zone I would be looking at, which I would wait for this one. And there's going to be red folded US dollar news today. So I would really be careful. And it's Friday as well. So markets are very volatile. I would mark this zone here. Oh, wrong way. So this zone here would be a B+ setup, right? So this is what I would be looking at. I'd be patiently waiting to see if price is going to come up here. I'd put my short tool, stop loss at the red line, entry is at this white line here, which is actually preferred entry. And then I would be targeting this lower low here, right? So you can see the difference there, 1 to 9 risk to reward, because I've been a bit more patient. I'm waiting to see what price does. This is a 1 to 3, yeah? So lots of people will probably be entering the market here. And then what they will do, the market movers will take your stop loss because of all of this liquidity up here, tap into this zone, got a beautiful basing candle there on the 4-hour. You've got a leg in, a beautiful leg in, and a huge drop, right? So there's so much liquidity that needs to be taken there. So this absolutely would be my preferred entry. And it's a 1 to 9 risk to reward. So you're risking 1% of your capital and you're gaining 9%. So that would be mine. So this is the weekly time frame on oil, okay? See this gap, this huge gap here. So on Sunday, the 22nd of February, when market opened, this is where we closed on Friday, yeah? We opened and there was a gap up on the weekly. So if you move down to the daily and the 4-hourly, that gap would have been massive. So first of all, positioning tool was here. Right, so I put my positioning tool there. My long position would have been here. Well, it was here, and I missed this trade. I'm still not over it, by the way. I'm actually not over the fact that I missed this by literally a few pips, skin of my teeth. I would have targeted here because I do think it's going to go to the higher high. But I could have left a runner, but actually there was a gap here that I was looking at. So it was like a 1 to 3.5, 1 to 4 risk to reward, which I missed, but anyway. So this huge move up went up, right? And then it came down like a magnet to this gap. This candle, it tapped in to this zone. You can see it taps in. So that it missed my entry by a few pips because I had my entry on the daily preferred, which I'm kicking myself about, but anyway. And then it flew up, which is 1, 2, 3 weeks. It's been on an upward motion. And I do think it is going to continue. There will be small pullbacks, but it is going to continue, especially with everything that's going on with America and the Middle East. But I've got to sign off, and I hope this has been useful. I know it was a bit quick, but it's just what I'm going to have to do when I can, when I've got the time to break down some trades for you. So Friday, I would be really cautious because there'll be lots of US dollar red news. So look at Forex Factory before you place any trades. If you're doing intraday trading and your stop losses aren't that big, I would just cancel the orders. I wouldn't even be trading around the news because you can blow accounts and lose lots of money. Uh, I will see you on the next video.